at the purpose of, and then also journalize and post all of the closing entries, which is us finishing out the accounting cycle. And so it starts out by just explaining what the closing process is. And the closing process zeroes out all revenue and expense accounts so that we can measure each period's net income separately from all other periods. And so if we take a step back and see, ask ourselves, what is that saying, or what does that actually mean? It's our way of ensuring that we can calculate income per one period. If we didn't close out revenues and expenses for the period that we were calculating the financial statements for, and it just continued on, how would we ever say, think if we were looking at a company that's been in business for 10 years, but the revenue account has just a huge accumulation of all of the transactions from the last 10 years, it would become really hard to say which revenues and which expenses belong to which year. But by closing them out, they're temporary accounts. So by closing out those temporary accounts, we're able to zero them out and start fresh for the next period. And then it makes it easy for us to follow that time period concept. So that brings up the next point of a temporary account. And a temporary account is the type of account that's closed at the end of the period. And so like we just said, that's all revenues and expenses. It's also the dividends account, and this new account called income summary, which we have not had before now. We're going to introduce it for the first time as part of this closing process. And so it's just a temporary account that we use specifically for this closing process. And we'll talk about that a little bit more in just a second. Alternative to temporary accounts are permanent accounts. And so the permanent accounts are all of the things like the assets, the liabilities, and then as far as equity goes, it's common stock and retained earnings. And they are not closed at the end of a period, so they continue to maintain their balance from one period to the next period, whereas the temporary accounts, the revenues, expenses, and dividends, will be closed at the end of every period and start at zero for the next period. So these closing entries then transfer revenues, expenses, dividends, and retained earnings. And by do that, zero out those accounts and prepare the company's books for the next period. So when we're doing that, we're essentially transferring revenues and expenses and dividends to retained earnings. And if we look back at our accounting equation, the subset of equity, here we go with my crazy drawing on the board, or on the not board. We said dividends, plus revenues minus expenses. And so we are transferring revenues, expenses, and dividends to the retained earnings account. And we had said that this chunk of the accounting equation is retained earnings. So it makes sense in that way that when we close these out, we're going to close them to retained earnings. If we have an income, that increases retained earnings. If we have a loss, that decreases retained earnings. And dividends always decrease retained earnings because that is a payment out of retained earnings to the stockholders. So the process starts by closing out all revenue and expense accounts to a new account called income summary. And like I said in the previous slide, income summary is just a temporary account that's going to be created for the purpose of these closing entries, and it's going to summarize net income or net loss for the period. And so you can see in Exhibit 4-5 the closing process. I think that seeing it visually like this is really helpful, and I would even recommend printing this exhibit so that you can refer to it when you are closing accounts. The first process is to always close our revenues, and so since revenues have a normal credit balance, to get this to 0, we need to debit all of the revenues. So we'll debit the revenues and we'll credit income summary for the total of all the revenues. The second part is to close expenses. And so expenses have a normal debit balance. So we will credit the expenses and then debit income summary. And that will provide us with a net income or a net loss. The third step is to close the income summary account to our retained earnings account. And so if we have a net income, that'll give us a credit balance on the income summary, which means we will debit income summary and credit retained earnings, which increases, put an arrow here, our retained earnings account. Alternatively, let me change colors. If we had a net loss, it would show up, sorry, this is looking a little scary. It would show up on the debit side. So step 3 instead would be to credit income summary and debit retained earnings. So the journal entry would be a debit to retained earnings and a credit to income summary. And that would decrease retained earnings. And then finally, we close out dividends to retained earnings, and so we credit retained earnings and we credit dividends, we debit retained earnings, and that closes out that account and decreases retained earnings to give us an ending balance. And this ending balance will match the ending balance that you've prepared and posted to your financial statements. So now we kind of walk through that process and see what the journals look like. So it's saying we start with closing out our revenue accounts, and we do that by debiting revenues and crediting income summary. You can see here on the T accounts that now our service revenue has a 0 balance and our income summary has a credit balance of $17,500. Step 2 is to close out all of our expense accounts. And so we have an example here of rent expense, and it has a debit balance of $3,000. We credit it $3,000 to get a 0 balance. And we would do that with all of the expense accounts. So you can see rent, salary, supplies, utilities, depreciation on the building and furniture, and interest expense, and they're all debited in one compound entry to income summary. And so then you see when that's posted to the income summary T account, it gives us a credit balance of $8,550. And this means that we had a net income. If it would have been a debit balance, that would have meant that we had a net loss. All right, so then step 3 is to close out the income summary, and so you can see that they debited the income summary and credited retained earnings. And so that zeroes out the income summary and is an addition to retained earnings. And then finally, close out the dividends account. And so you can see here a credit to dividends, a debit to retained earnings, and that gives us a final balance of $3,550, and that matches the balance of retained earnings on our balance sheet. And if that's not the case, then we have a mistake somewhere and we need to go find it. And so here we can see the actual journal entry where we're debiting retained earnings and crediting dividends. That's that. It's the same thing that we're seeing in the T accounts, just in journal form here. And Okay, and so this slide is just showing if we would have had a net loss for the period, the closing entry to income summary would be the opposite. So as you can see, if there's a loss, then we debit retained earnings and we credit income summary. And so I mentioned that on the previous slide, but just again, here's an example where you can see that happening. And then exhibit 4-6 is here, and it's a summary of all of the closing accounts. So you might want to look at that closer. It's always revenues first, then all of your expenses, then you close out income summary, and then finally you close out dividends. And so this process looks the exact same every period, just the account titles might change a little bit, and there might be way more expenses, but the process is always the same. It's always revenues, then expenses, then income summary, then dividends. And this just is showing the T accounts, which kind of align with, let me jump back up, this little chart that was showing revenues to income summary, expenses to income summary, to retained earnings, and then dividends to retained earnings. We can just see it in T account form here, summarizing that same process and all of those journals that occurred in the closing process. And that's it. So hopefully this feels a little bit easier. It's a really consistent process that looks very similar every time. A few more, a few less accounts might be involved, but it's always the same. Close out revenues, close out expenses, close out your income summary, close out dividends. So, all right.